Welcome to Yellow Tunnel. My name is Vlad. I'm CEO and founder of Yellow Tunnel and TradeSpoon. And today I'd like to go over current market sell-off and also discipline on how to deal with the market sell-off. For those of you who are new, you can take a quick look at my bio. I'll leave the slide for a second so you guys can read or pause for those of you who are new. Disclosures are very important, trading stock and options. I'm going to go through some of the trading examples, so very important to read the disclosures. Trading stock and options involve risk and are not suitable for everyone. You must be aware of the risk and be willing to accept it in order to invest in current market conditions. I'm not a financial advisor, I'm not registered with FINRA nor SEC. I'm showing you what I do in my own account based on my own tolerance level for general education information purposes only. Please consult your financial advisor prior to making any trading decisions. Also should not be assumed that the future trade picks will be profitable or will equal past performance. All right, so last week we talked about two different topics. One is the black swan and uncertainty in the market. Today we've seen an example of the pretty steep sell-off. We have the biggest sell-off since January. So you would consider, every time the market moves 2-3 standard deviation, you would consider this an outlier. You can see on the news, everybody's trying to explain why there is a sell-off, how far the sell-off can continue, whether it's going to rebound, whether we're in recession, or when the market will rebound. So there's definitely, hindsight bias and trying to rationalize what happened in the market. From my perspective, there are two forces that drive every trading decision. On one hand, you have discipline. On the other, you have uncertainty. So the question is, who's going to win? Will the uncertainty win and the market sell-off, or will the discipline as a trader prevail? We covered, Dr. Menaker was with us last week. He had an hour webinar. I encourage you to review it. In short, he talked about three main concepts behind a disciplined trader. One is flexibility on the view on the market. If you were bullish on the market last week before the FOMC meeting and now market is selling off, then you probably want to start changing your view and become bearish until you have empirical data or you have evidence in the market that the sell-off is about to end. Second one is confidence. Confidence takes time. I encourage you to review Live Trading Room. I speak about confidence and how important it is to build confidence. True confidence takes time and practice. That's what Dr. Menaker said. There is a concept of short-term volatile confidence versus something long-term, something more permanent as a confidence in the trader. When you have a trading plan, you discipline, and you are following your trading plan no matter how big the outlier event happens. And instead of the third one, instead of focusing on what you cannot control, and you cannot control who is going to say what in the media, right? We can't control the media. We don't know at what point the market will reverse. Usually it happens with the announcement that either interest rate decision has been, we will lower the interest rate. That can cause the market to reverse, or there's kind of a short-term peace agreement with China that can reverse the market sell-off. And until then, since you cannot control the news or the timing of the news, until then you have to be a disciplined trader and assume until the news come in that the market will trade between certain support and resistance level in the market, and that's what I'd like to talk about. Before I jump into the support and resistance levels and when to consider buying, when to consider selling, some of the warning signs, document your thoughts in the trading journal and label your thoughts. If you see you're hoping that the market will rebound, or you're getting into a trade because you think the market is going to continue to sell off, and you feel like you're missing out on the sell-off and you want to jump on the train, if your primary decisions are not based on empirical data on the market, but more on the feelings of what you hear on the news, the first step is to recognize these thoughts, keep a trading journal, go through both negative scenario and a positive scenario if you do get into a trade. Refer to your trading plan, try to avoid trading based on emotions, stick to the trading plan and stick to your target gain and stop losses. Live trading room is very important. You can share your thoughts and ideas in the trading room environment with your peers and with the coach in case you're trading in the live trading room and TradeSpoon. And empathy, recognize that ultimately The events are impossible to predict when they come out. And it's not a question if you're wrong or right. The question is, are you disciplined versus not disciplined? And do you have a confidence in your long-term trading plan? I talked about key parts of the trading plan. You have to find system based on statistics. Always look at 200-day simple moving average and 50-day simple moving average. Last week I said 50 days is a key support. We broke through the support. Now 200-day moving average is a key support. We actually pierced through 200-day moving average both on S&P mini futures and on Dow Jones futures. So both key levels were violated today, and this is a key support. So we have to see if tomorrow we can bounce back off of this support of 200-day moving average, or will we continue the sell-off. Structure your trade with favorable risk versus reward, and hedge your position. We talked about spiders puts, treasury, gold, VXX. All of these are instruments that we are trading in our live trading room environment, and raise cash. At this point, you should have at least 30% of your portfolio in cash. Based on your background, it could be 50, it could be 80%. But it's very important to have cash in your portfolio at this point. So let's take a look at the market. Looking at the spiders, model just ran. It sees that the market is oversold. It sees support for tomorrow at 278.67. This is exactly where we are right now based on the futures. The US Treasury Department mark China as the currency manipulator after lowering its currency. That caused futures to sell off further after the market as we speak. This is 6:40 Eastern. So currently we're at 278.67. We closed at 283.82. So market continues to sell off. And based on the predictions, the model basically shows, well, we're going to reach 278, probably rebound, maybe 289, 290, and then continue its sell-off. So that's what the market predicts. That's what it predicted today. We didn't have a bounce because of the news, but short-term market is oversold. It's a 200-day moving average. It's at 278. Looking now at the seasonal chart, that provides a very similar picture. It ran on Sunday, basically shows that 3 out of 4 predictions are higher. This is going into the next 20 to 50 days. Now the time outlook of this model, seasonal chart, it makes predictions for 20, 30, 40, and 50 days. So now we're looking at the October. And now looking at the October, model basically says that the prices in October will be higher than they currently are. So I think short-term from seasonality point of view, we do see that, in August, usually market does sell off, not as steep as right now, but there is a seasonality component to the market also. And then going into September and October, market usually rebound. So I think this is the likely case scenario. Again, I'm looking at S&P futures. September contract. As we speak, futures are deteriorating at 27.85. We're very close to 2 standard deviation move, very close to the support. The lows that we've reached in end of May and the lows that we have reached in March. Right? This is a very important point, also corresponds to 200-day moving average. If yesterday and this week we're unable to hold on to the 200-day moving average, then the path of least resistance is to continue the sell-off, and potentially next stop is 2600 level. So how do you trade this environment? You probably want to wait for confirmation, just like we had in May. After the sell-off, after we pierced 200-day moving average in end of May, we had a reversal and then the next leg to the upside. Some people wait 2 to 3 days. So before you go long, I would suggest to wait if the 200-day moving average will be established, and then you put a stop level below the low, and after the confirmation you can go long. That's one trade idea of the confirmation. If we're unable to hold on to the 200-day moving average, then you can do the reverse. This is the point of being flexible. If you see tomorrow we are piercing through the 200-day moving average and we're below 2740 on S&P futures, and we're unable to hold on this level for 2-3 days, again, you wait for the confirmation, and if we continue to go down, then you establish a short position, and after the confirmation, you wait till the market sells off to the 2600 level. So very important to recognize the support and resistance level. We had 2900. This was the 50-day moving average. We pierced through it without hesitation. Now we're at 200-day moving average, same thing. You want to wait for confirmation, 1 or 2 days. And market either going to rebound, then you can go long and have a tight stop level, or the market is going to pierce through 200-day moving average, then you would have to be short, and same thing, you would have to have a stop level, very well-defined stop level. If you don't have rules in terms of the stop levels and very small, 1%, 2% stop levels, short-term stop levels, then I would suggest to wait until, don't trade, raise cash, have most of your portfolio in cash. One would be approach, based on your background, you can consult your financial advisor, what's the appropriate level of cash in your portfolio, but wait at least for confirmation. Currently, market is oversold, and you just want to wait at least 2 to 3 days to see if the market is going to continue going higher, or wait 2 to 3 days and see if the market is going to go lower, because we are at a key support level that spans over to March of this year. I encourage you to review Dr. Menaker 1-hour webinar. You can find it under recordings. This is what you need to be disciplined. And that's all I have for today. Thank you.